So retail investors are not going to purchase the bonds directly. So for them, they are not going to calculate the bonds duration, modified duration. In the real world also, fixed income understanding is not very high. When I do corporate trainings also, I realize that equity understanding is very good among the investors and advisor community, but the fixed income is a little complicated. That is because there is some bit of mathematics that goes into it. I personally believe it is not much of advanced mathematics, but then obviously, if you are new to this and if you suddenly see so many numbers, it tends to get a little intimidating for new investors or new advisors in the market. But if you realize the world of investments, majority investments are in fixed income. So everybody tends to invest more in money of their portfolio in fixed income. Even if you look at your own portfolios, if you're investors, you may have more money in fixed income. You may have public provident fund, you may have employee provident fund if you're employed with the company, you may have a lot of investment in FDs, you may have investment in debt funds. So all that is your fixed income portfolio. If you have home loans, again you're talking about a fixed income liability. So fixed income is an essential part of most investors' life. Saurabh has an interesting question. Why would an investor purchase a security with negative yield? Because it is all relative. Everything in the world of investments is relative returns. How much are you getting on a relative basis, on a comparable basis? And again, as I said, don't imagine a retail individual investing, imagine a bank or a mutual fund investing. So if I am in Europe, suppose I am in Germany today, and let's say there is a bank in Germany called Deutsche Bank. Deutsche Bank, one of the largest banks in the world. Now, Deutsche Bank, let's say, has a 500 billion euro investable surplus. This is their investable surplus. They have got 500 billion euro surplus. Now, Deutsche Bank is not retail person, right? So you can't hold this in cash form. You can't go and withdraw 500 billion euro and put it in cash. So you have to invest it somewhere. You have to invest it somewhere. Now, if Deutsche Bank puts the money with the Central Bank of Germany, Bundesbank, or if they put it with the ECB, European Central Bank, for example, suppose Deutsche Bank says, you know what, I don't want to invest it anywhere. I just want to keep the money slightly safe with the central bank, like India also do. If you know, Indian banks keep the money with RBI. So in countries like Germany, the central banks are giving them negative returns on this deposit. So in other words, their policy rate, like we have repo rate, if you understand, their policy rates are negative. So they are discouraging banks to keep the money with the central bank. So if these policy rates are negative, suppose it is minus 0.5%, they have cut it to negative, by the way. It is like RBI has cut it to 4% today, if you know, if you keep the money with RBI. Suppose RBI cuts it to 3 and then 2 and then 1 and then says, you know what, let's keep it negative. What it means is Deutsche Bank, if it goes to the central bank and says, keep my money, I would want to keep it with you. Central bank is like, no problem, you can keep it with me, but you have to pay me interest. Deutsche Bank has to pay interest. So now what DB will do is, DB will say, you know what, let me try and invest in government securities in Germany. German government securities. We call it Bunds, by the way. In Germany, we call it Bunds. Like bonds, they call it Bunds. The German Bunds, very popular security in Germany. So what Deutsche Bank will say is, if I am getting negative 0.5 here, I would rather invest in German Bunds, which means the demand for these bonds will increase significantly. It will increase a lot, if you understand, because there is money and I don't want to park it with the central bank. So demand goes up, supply remaining constant, the price falls. Sorry, the price rises. And price rises so much that the YTM goes negative. And it is okay, right? Because suppose the YTM is minus 0.2%. Please understand, Deutsche Bank will be happy to earn minus 0.2% as compared to earning minus 0.5%. That's why you have to understand it is all relative. So if you think in your mind, suppose Deutsche Bank wants to avoid losing 0.5% and Deutsche Bank also wants to avoid losing 0.2. The question you have to ask is, what will Deutsche Bank do with this 500 billion euro surplus? Where will they earn risk-free positive returns? Risk-free positive. See, they can lend it. They can give loan to a corporate. They can give loan to an individual. But understand, they are not wanting to. Economy is in recession. Nobody is borrowing. The default risk is higher in that economy. So Deutsche Bank is like, I don't want to take lending risk. Where do I park it now? Because central bank gives me minus half. Government bond gives me better. I hope you know minus 0.2 is better than minus half for an investor. And what else? I mean, there is no other opportunity, right? So that is why bond yields can go negative. It's all relative. Don't say why invest, just keep it with yourself. I mean, what do you mean by keeping it with yourself? That's cash. How can you keep 500 billion euro in cash? I mean, think of the security risk. I mean, more importantly, where will Deutsche Bank get so much cash from? ATM में जाके withdraw तो नहीं कर सकता. So that is why negative yields are reality in Japan, Europe, maybe US will also go to negative yield if they see themselves in a full-fledged recession. To understand, these are all techniques to revive economic growth. Lower the interest rate, higher the borrowing, higher the consumption. That is what you're trying to do. With ample liquidity in the system and banks SLR at 26%, more than mandatory requirement, do you expect GSEC yields to come down? It would basically depend. So what you're saying, Gururaj, is the demand side of the equation, and you're right. From a demand point of view, there is a lot of government security demand already being there. But if you understand, holding excess government security is not supporting price. What you're indirectly going to say now is, oh, that means they can sell government security if they want. So they are holding excess means there is not much opportunity. Otherwise, that is why they are buying. So demand is very strong. You also have to look at supply side. Prices and yield are demand supply, both driven. Now think of the situation. We have a corona effect. The economic ramification will be severe. Most economists is already saying that India's GDP will not be close to 5. We may go down to, let's say, 2%. In fact, I personally believe if we are able to get a 2% number for fiscal year 21, we are damn lucky. We are damn lucky. Now, the world is definitely going to get into negative growth very soon. So when you are facing so much economic risk, economic issue, government will spend a lot, right? They will give a lot of fiscal support. What they have given as of now is nothing significant. $27 billion is what they have given, roughly close to 1,70,000 crores, which is nothing for the current situation. So I do expect government to spend more. So government to spend more means more fiscal deficit. More fiscal deficit means more government bond supply. So if government bond supply also is very high, please understand, prices may go down, yields may go up. So it's not a very one-sided thing that you will see. It is going to be a tricky situation. Demand is good because of excess liquidity. Supply will also increase at some point. Both of it will kind of play against each other. My personal view is, and that is obviously something which I can be totally wrong on, the government bond yields from wherever we are now will go down slightly. We will go down from current levels, but I don't think it will sustain there. We will probably see supply level excess bonds and we will come back to the current levels. So I expect the 10-year government bond, which currently is at around 6.1, 6.2% zone yield, to go down slightly. It may go down to previous lows, but I think it eventually will come and settle around here if things go as per estimate. I hope you know estimating in current situation is very, very risky because nobody really knows what is the impact of virus going to be. So I have my disclaimers, obviously. I can't help it. So you're talking about demand side, Gururaj, I totally understand. But don't forget the supply side. Higher fiscal deficit, higher government bond borrowing could also happen, which is not really a good thing for bond markets. Now, if I take you to the fact sheet of a mutual fund, just for your understanding, this is the fact sheet of IDFC Mutual Fund. IDFC. My ex-employer, so I should add that as a disclaimer. My ex-employer. This is the dynamic bond fund of IDFC. Dynamic bond fund is the mutual fund category which ends up taking the highest interest rate risk. So they can change their portfolio to suit their interest rate view. So if you see that this is the dynamic bond fund, you can see something in the portfolio. So you see it's a 2000 crore fund roughly. They have 2000 crore in this fund if you see, managed by their head of fixed income, Sriyash Chaudhary. Three bonds they have invested in, as you can see, three bonds. These are the three bonds. We are in 2020, so roughly, if you understand, this is a 8-year maturity bond, residual maturity. This is a 7-year maturity bond, and this is a 5-year maturity bond. Most of the investment is in the first two bonds. If you see, majority is in the first two bonds, which is 8-year and 7-year. So if you multiply the weightage of this bond into, if you multiply it with the residual maturity, so 8 times this much plus roughly 7 times this much. So if you see, if you multiply it, you will get the average maturity of the portfolio. If you see, it is 7.66 years average maturity. This is the portfolio's weighted average. What we calculated was maturity for one bond. This is the portfolio's average maturity, 7.66. If you can see, majority is in that 7 to 8 years bucket. That is why it is coming between 7 and 8. For each of this bond, if you calculate the modified duration, imagine behind the scene, each bond has a modified duration also, right? Which will be lower than the maturity. So if the maturity is 8 years, duration will be lower than 8 and modified duration will be further lower. For each of the three bonds, modified duration is lower than their maturity. The weighted average of that is what you see here. Modified duration of the portfolio, 5.8 years. And how do you interpret 5.8? Roughly 1% change in bond yield, there will be a NAV fluctuation of 5.8%. So suppose my view is right. Suppose my view is yields are going to fall in the near term because of excess liquidity, like Gururaj mentioned. I also personally expect RBI to cut repo rate further. They cut it recently, but I expect them to cut further because there is a need for more monetary support in the system. So April, they have a monetary policy meeting next week. Suppose they cut it further. Suppose the yields go down. If the yields go down by, let's say, 50 basis points overall, then the portfolio NAV will go up by roughly 2.9%, which means if you invest now and the yields go down, you will be able to get capital gain from this portfolio. So if you have an interest rate view, you can connect the interest rate view with the modified duration of the portfolio. And I hope you understand it works both the ways. So if yield goes up, you will have a loss also, which is capital loss at this ratio, 5.8% for 1% change in YTM. This is a very rare fact sheet. I'm saying it because I compare fact sheets a lot. This is a very rare fact sheet where you see modified duration mentioned. Most fact sheets will mention duration, Macaulay duration, which will, I hope you understand, be higher than this. So if a fact sheet mentions Macaulay duration, you can broadly take that Macaulay duration, divide it with 1 plus the yield which is given, YTM for the portfolio. This is also weighted average YTM of these three bonds. So Macaulay duration divided by 1 plus YTM will roughly give you modified duration. So you can interpret data based on how it is given to you. And if you see, there are short-term bonds which will have a lower duration. Let me show you short-term bonds. This is short-term. As you can see, IDFC short-term bond fund. And because it is short-term bond fund, look at the average maturity, only 2 years and not 7.5 years. And what is modified duration? Only 1.8 years. Meaning, if now the yield for this portfolio goes up, the NAV will fall, but not as much as a dynamic bond fund NAV, because lower the duration means lower the interest rate sensitivity. Higher the duration means higher the interest rate sensitivity. If you go into ultra short, which is further short term, if I take you to the ultra short fund, this is ultra short. This is like Macaulay duration. You can see here, Macaulay duration will be between 3 and 6 months only. 3 and 6 months only, which essentially means that we are talking about literally zero or very close to negligible interest rate risk. What is the modified duration here? 150 days, which means roughly zero point 0.4 years, 0.5 years. Meaning if the NAV, if the yield goes up by 1% also, please understand 1% yield movement is very, very high. The portfolio will only have a shock of just about 0.4% NAV fall. So lower the duration, lower the interest rate risk. As investors, as advisors, we have to know a little bit of interest rate view. If you don't have any interest rate view, if you don't know where yields are going to go, then please do not get into duration risk. Don't invest in higher duration funds because you are not sure how it will behave. Then keep with lower duration. You may want to take credit risk. Credit risk is a separate risk. Like this portfolio is all AAA. You may want to go for a AA portfolio or a A plus portfolio. In my first session, I showed you uh, Franklin Templeton portfolio, which has higher credit risk. So it's up to you. Do you want to take credit risk? Do you want to take interest rate risk? Do you want to take both? That's how we analyze and interpret the bond funds and invest accordingly. Can modified duration be negative? In the Indian context, no. Numerator is positive, denominator is positive, answer will be positive. Negative modified duration means basically a mathematical way where one of the numerator or denominator is negative. We are talking about always percentage change as positive, which means if yield goes up, price will fall, and that percentage change we mention as negative. By the way, just to tell you, Saurabh, mathematically modified duration is always negative only because the relationship between yield and price is negative. So answer always comes in negative if I talk about it purely mathematically. Yield goes up, price falls, right? So the rate of change is negative. If you think mathematically, we are talking about what is called as negative slope. So very, very technically modified duration is negative only. So that is what I wanted to tell you in this particular session, where I wanted to kind of cover this calculation also. You, I presume, have my contact details. Feel free to ask me questions there also. This is my WhatsApp number. Feel free to ask questions. I will have more sessions that I will do, but maybe on derivatives next time, maybe on futures and options. I haven't planned the schedule. If you want the Excel file, please WhatsApp me. I will send you this Excel file. And Akhil reminded me much later that I was not recording this session. So thank you, Akhil, for reminding me, because I usually upload, but I messed up today. I did not record it from initial level. No problem. That's okay. I hope you had some value addition today also. I hope you could learn something about bonds and duration and fact sheets a little better. Don't forget, if you like something, do donate to certain charity. The purpose of these sessions are that also try and contribute to that. I will try to we take a session on war. I am not committing, Saurabh, because when I did some survey on what topics people are interested in, war was not really up there. The first demand was for fixed income session. The next was for derivatives. The third one was for equity. So I'm just kind of taking that majority view. Nothing, no other reason as such, because that's the logic. Plus, don't forget, after lockdown, also I intend to continue this. I am kind of having this for a long time. I had this plan of doing sessions and recording and uploading on YouTube for anybody to see, because knowledge always can be useful. So maybe at some point in time, I will take a session on war, not committing it for the time being. Thanks a lot. Have a good weekend ahead. Every day is like a weekend now. Thank you so much for your participation. Again, I'm very thankful. Take care. Bye bye. See you.